Hello viewers, welcome to Centricity, आपका wealth partner. Today we have Vinayak with me, who's the product head at Centricity. The idea of doing this video is essentially to learn how to position PMS as a product class amongst our investors. Often what happens is that when we go and try to pitch PMS as a product to our investors, there are common questions which are asked, and we tend to answer in a very subjective manner. The idea of this video is to have very objective answers to the questions posed by investors. So Vinayak, welcome to Centricity.
Thank you.
I think the first thing that we can start with is to kind of define PMS in a very simplistic manner. Because PMS is a very used and abused term. PMS can be used to describe a lot of things. But in our parlance, what is typically known as a PMS? What is exactly a PMS?
So as the word suggests, it's a portfolio management services. So basically, the underlying portfolio can be a debt portfolio, which could be of bonds. It can be a equity portfolio, which could be of listed equity underlying stocks. But it is a actively managed portfolio by an expert team of or an expert set of fund managers who have a long-term track record in managing portfolios.
Okay, so what are the different types of PMSs that are available in the market? Are there different segments? Are there different themes or fund management philosophies? And what is the main structure of a PMS that an investor usually invests into?
So, if we broadly look at Aditya, there are two types of PMS that broadly, all other theme, sector, philosophy, processes come under those categories. So, one is a discretionary PMS, one is a non-discretionary PMS. Most of the investments are routed through discretionary PMS. The word says discretion, where the fund manager has the discretion to decide on what actions he is taking into the portfolio. So, basically, an investor has given money to a fund manager. Now, the fund manager decides what to buy, when to sell. The investor has no say in it first. In an NDPMS, which is a non-discretionary portfolio management, the fund manager basically takes an approval for any investment or any redemption from the specific investor. So basically there the discretion is with the client, not with the fund manager.
Sure.
So these are two broad categories.
But for both these type of PMSs, there is a certain fee that the fund manager charges. For dispensing advice or what.
Yeah, the fees can be a fixed management fee. The fees can be a purely variable fee structure, wherein if the fund manager generates a certain amount of return, then the fund manager charges a fee. Otherwise, he will not be able to charge. Or there could be a hybrid structure as well, where there is a minimum fixed management fee for managing the expenses of the portfolio management services, and the fund manager charges a carry or a performance fee as and when he generates a returns above a certain hurdle rate, let's say.
Certain hurdle rate.
Yeah.
So okay. So these are the two types of or two or three types of fee structures that the PMS accrues. And so if I ask you a very blunt question, why should one look at a PMS to invest in vis-a-vis plain simple equity mutual funds? If I purely compare an equity PMS with a mutual fund, why should one look at a PMS and not an equity mutual fund? Especially given the fact that it could be a fact also, or it could be a general perception also, that equity PMS usually accrues a higher fee to the investor vis-a-vis a mutual fund.
See, I think this is the most important question for any investor first. First thing and the foremost thing, that every investor usually, why they invest in PMS is for higher returns. That we have to understand. This is the main criteria for any investor, and this should be because see, in mutual fund, it's a mass product, it's a retail product where the minimum investment will start from 500,000 rupees and you can invest up to any amount. But in PMS, the minimum investment is 50 lakhs. So if you are committing 50 lakhs to a specific theme or a strategy, then definitely your return expectation should be higher as compared to a traditional product, which is a mutual fund. So in that case, and the second main difference that I would like to highlight here is, in mutual fund, a 1,000 crore client or a 1,000 rupee client will have a same portfolio.
They'll have the same NAV, they'll have the same treatment, same portfolio. Everything.
Yeah, and more importantly, they'll have, so let's say if I have invested 10,000 rupees in a mutual fund 10 years back, and today also I'm holding that mutual fund, and let's say you have invested that mutual fund into that mutual fund yesterday, both portfolios are similar at one point of time, which is today. But let's say if somebody has invested into a PMS 6 months back and somebody who has invested today, their portfolios in the same PMS strategy can be different. Although I would say 60-70% of the underlying holdings should be similar, but depending upon the underlying stocks, which stock has run up how much the fund manager is comfortable sharing or holding that stock right now will also be depending upon the market scenario. But usually 60-70% will be similar, but it is a customized, it is a personalized portfolio for every investor.
So I think to summarize, the two main reasons why one would even consider looking at equity PMS is, one is that the expectation of a higher return and outperformance, absolute outperformance vis-a-vis the benchmarked index, and especially as compared to the nearest comparable equity mutual fund. Second is that there is a certain degree of specialization, customization that goes into building up a PMS portfolio as compared to an equity PMS, where you mentioned that there is literally no differentiation for a client who has a very large ticket in an equity mutual fund vis-a-vis somebody who's running a 500 rupee, 1000 rupee SIP into the same scheme.
Yeah, see, a few more differences is mutual funds usually track a particular benchmark. So it's more, they more track the returns on a relative basis as compared to a PMS where they are benchmark agnostic. They are not looking specifically for a benchmark. Usually their active ratio or their active portfolio for a specific benchmark is way too different. Their active ratios can be 90%. That means, let's say if a benchmark has 10 holdings, then that means that a PMS can, out of those 10 holdings, can only have 2 holdings in the PMS services rather than entire 8 or 10 holdings of that benchmark. So it's a completely different portfolio as compared to a traditional investment like mutual fund.
And can PMSs also invest in some early stage stock ideas which are listed but probably not picked up by an equity mutual fund, so they can take a bet on that also, which is relatively more aggressive?
See, this again comes back to the point. See, as an investor or as a PMS manager, the PMS manager actually tries to outperform the mutual fund or a relative benchmark as well. See, if a investor is committing a substantial amount, let's say 50 lakhs to a particular strategy, then the PMS manager also knows that the investor's return expectation is that at least you outperform the benchmark and the mutual fund in the same category. So most of the PMS, specifically in mid and small cap category, if we look at, they try to invest in companies which are at a very early stage, which are not being discovered by most of the institutions and mutual funds, so that they are able to generate higher returns before they are actually discovered.
That is also a very critical difference between, because to the extent that I know, equity mutual fund usually have a very set universal set of stocks within which they will basically they will pick their own stock portfolio. For example, if there is say 500 stocks in the mid cap space as far as the Nifty index is concerned, they will basically pick the stocks from that universe only. They will not go very far. The apple will not fall very far from the tree.
Yeah.
So whereas a PMS fund manager has that flexibility. Also, from what I believe, a PMS fund manager has the flexibility to build a portfolio also according to his comfort. It may not be necessary that he will basically pump in all the money on day one. And some PMSs, if I'm not wrong, also offer the flexibility of hedging portfolios if there is a certain profit which is accruing in the portfolio. For example, if he believes that there is markets have become expensive and there could be a short-term or medium-term correction, he could offer hedging services through derivatives so that the profit which has been accrued in the portfolio can be protected, right? Which is something that equity mutual funds cannot do at all.
Exactly. See, in mutual funds, once you have invested, so in mutual funds, let's say you invest today, so whatever the underlying holdings of that mutual fund, the entire money gets deployed that day only. But in PMS, it's not like that. It's, let's say if you have invested 50 lakhs today in a PMS, the fund manager can take up to months to invest the entire 50 lakhs into the equity markets. He can take its own time. He might deploy 25-50% today, and he might, depending upon the market levels, depending upon his comfort on the market valuation, he might take his own time to invest the proceeds basically.
So one more very typical question that it is a question which is common with mutual funds as well as a PMS also. As everybody would know, there are more than 1,000 PMS schemes which are available in the country, and there are various platforms which compare and give you comparative analytics between which is the top performing or top quartile PMS, bottom quartile PMS, etc. But still, the more the information, the more confused an investor is. So, somebody who has money to invest in a PMS, the main dilemma that he faces is that who to believe and how to objectively decide which PMS to invest into. So, if I ask a question very simply, which is the best PMS to invest into, what will be your answer?
There is no best or worst PMS, or there is no good or bad strategy. See, we have to understand every fund manager is following a particular philosophy. There is a process. There are multiple analysts behind a portfolio management services. They decide on which sector, which theme to follow at a particular point of time. But see, market dynamics also keeps changing. So if a fund manager is sticking to a philosophy, let's say a fund manager is following a growth oriented strategy or a value style of investing, and let's say the market is right now in a momentum where growth stocks are in favor. So the value strategy might not be the top performing strategy, but that doesn't mean that strategy is bad.
Right.
So as a investor or as a distributor, the main theme when you are investing into a alternate investment product like PMS, you should also look at how the market is placed today. What are the market dynamics? How we are looking in terms of how the market is positioned for next 2 years, 3 years. I mean, this type of factor should also come into the picture once you are investing into a specified theme or a strategy.
So, which are, if you can name like a set of 3 or 4 parameters that Centricity chooses very objectively to score PMSs and then arrive at a list of say 8, 10, 12 PMSs that our partners can actively take to our client, what would be those parameters?
See, the main parameter that we look into when deciding into a PMS is how the fund manager has done during different market cycles. So we try to look at PMS strategies which have usually at least a 5-year track record. See, there are a lot of strategies which do very well in a momentum driven market, and 1 year, 2 year you will see that those strategies outperforming most of the other PMS and mutual fund and benchmarks. But as a distributor, our role is to look for strategies which have done well over a certain period of time, because usually investors are not investing into PMS for 1 year, 2 year. They have a long term horizon when they are investing into PMS. So main parameter that we look is they should have a decent track record, which should be 5 years, 7 years, 10 years.
AMC as well as the scheme.
AMC as well as the scheme as well. Plus, what is the track record of the fund manager? That is also important, because see, most of the PMS guys, if you look at their background, they usually have started their business out of mutual funds only, and they now have started their own company, or they have started through a collaboration into a PMS services. So basically we have to see how they have done over their entire track record, what is the AUM that they were managing at a particular level once they left the mutual fund industry, or then so these are some quantitative factors that we have looked. Other than the return, we also look at the beta, the Sharpe ratio, the standard deviation, how much risk a fund manager is particularly, how much turnover is there. Some fund managers do a lot of turnover. Their turnover might be 2x, 3x of the portfolio in a year, and some are like a buy and hold strategy, wherein the average holding period of a particular stock in a PMS could be 5.5, 6 years. That means they are not churning the portfolio at all. So all these parameters at a quantitative level we do. At a qualitative level, we also look at the fund manager track record, the AMC AUM, overall the PMS AUM, and the strategy AUM. And the strategy AUM plays a very big role in mid and small cap. So we usually look for PMS houses which have a smaller AUM as compared to specifically in mid and small cap category as compared to mutual funds, because after a certain point of time, if a PMS has a higher amount of AUM into a mid and small cap strategy, then I believe it will be difficult for a fund manager to outperform, because opportunities in mid and small caps are few, and if the AUM is too big, then the fund manager will not be able to take positions.
So in summary, there are both objective as well as certain subjective factors. Objective factors would consist of what is the absolute track record of the AMC, of the scheme, of the what is the track record of and expertise of the team which is managing the the PMS scheme. Also things like rolling returns and the current year return and the last
calendar year returns,
etc., etc. And it could also be certain subjective factors in terms of what has been, the flexibility of the PMS as such, and what has been the behavior of the fund during times of crisis, etc., and what has been the knee-jerk reaction, what has been the long-term strategy for the PMS, etc. So it's a combination of both, objective and subjective factors. So, in your opinion, what is the value add the Centricity adds as compared to other wealth management desks, and what would be our value add to partners when they take these schemes to their partners?
See, as you
their clients. Sorry.
Yeah. See, as you have told, there are more than I don't know, maybe 1,000 PMS strategies that are there. But as a distributor, what we do is we do a due diligence on our part on both quantitative and qualitative factors. We give some amount of weightages. We have a internal scoring model wherein we try to score each strategy basis their return and risk parameters. And we try to filter out from each category, whether it's a multi-cap PMS or a mid and small cap, which strategies basis all these parameters have done and how are they positioned. So basically, as a distributor, our role is to cut short, let's say, from 500 PMS strategies to bring it 15-20 PMS strategies that we believe are positioned to do well, or they have done well, they have a good track record, plus at this market point they are positioned to do well in the next 3-5 years as well.
All right. So, and just one very last technical question, what is the difference in the taxation of a PMS scheme and equity PMS scheme and equity mutual fund scheme? Is it beneficial, or is it like the same as that of equity mutual funds, and does it really matter to the end investor what the taxation is?
See, first returns, when you compare a mutual fund return and a PMS return, you should compare both returns after net of expenses. That is the most important thing while evaluating the performance. But in mutual fund, mutual fund is a fund level investment that you are doing. So once you have bought a mutual fund, you are allotted some units, and till the time you sell those units, there is no capital gain that is accrued to you. So in mutual funds, within 12 months you are subject to pay short-term capital gain, which is 15%, and after 12 months you are subject to pay capital gain, long-term capital gain, which is 10%. Similar is the case with PMS as well. So in PMS, investments are not rooted through a fund. Investments are done at your PAN level. So basically, every investment that the fund manager is doing, buying a stock, is held in a demat account through your PAN, which is the taxation for all those stocks remain same. But let's say in mutual fund, when the portfolio is churned, usually you don't end up paying taxes. But in PMS, once the fund, since it's a dynamically actively managed portfolio, if a fund manager believes that a certain stock has run up in a very short period of time, he might like to book profits, and that could be within 12 months as well. So in that case, short-term capital gain will accrue, which will be similar to mutual fund, 15% and within 12 months. And in case he sells a particular stock after 12 months, then 10% long-term capital gain. But every time he buys and sells, the tax will be applicable to the investor. So it will not be subject to when the investor redeems the PMS scheme. It is subject to when the fund manager actually exits that particular stock.
So, although there is a difference between the taxation of an equity PMS and a mutual fund, I don't think for a long-term investor it makes a whole lot of difference, or very critical difference.
I mean, the underlying taxation remains same. It's just like that for mutual fund, your tax are getting deferred till the time you actually redeem it. In PMS, you are paying the taxes, you're not deferring the taxes, basically you are paying it as and when the portfolio is churned.
Sure. So Vinayak, I think we have covered the entire spectrum of facets in terms of what a PMS is about, how do we define it, how do we position it, what are the critical differences between an equity mutual fund and a equity PMS, what are the benefits of choosing supplementing an equity mutual fund portfolio with an equity PMS, how to choose it, what are the objective parameters to choose a equity PMS where one could possibly invest out of the thousands of schemes that are available, and last but not the least, what are the parameters that Centricity has internally to shortlist out of the very large universe PMSs that our valued partners can take to their clients with. So these are some of the very critical questions that we've answered today. Hope our team benefits from this particular
Aditya,
session?
before we end this, just one thing. It's not PMS is not a substitute to mutual fund.
Yes.
It is a complementary strategy which can add to the your overall portfolio returns. So I would suggest that all investors, all distributors should should look at the overall client portfolios. Look at the overall client exposure into equity before actually suggesting a PMS services. I mean, you should be aware of the asset allocation and how much in a single scheme exposure that you are taking. Usually, we believe it will be prudent to restrict your single scheme exposure up to 10%.
So thank you, Vinayak. I hope our viewers benefit from this. Hope our business development team benefits from this. Hope our partners also get crucial tips to position and pitch PMS products to their clients. Thank you so much for viewing this video. Please like and subscribe our channel. Thank you so much.
Thank you.
Thank you, Vinayak.